Did you know that nearly 90% of traders lose money in the markets? Ever wondered why, despite endless advice out there, so many people still fail? Could it be because the most common trading tips you're hearing are actually setting you up for failure? Welcome to today's video, where we're exposing the harsh truth about basic trading advice and why it might be more harmful than helpful. You've probably heard things like, cut your losses early, or buy low, sell high. But is it really that simple? Or are these phrases just scratching the surface of what it actually takes to trade successfully? Stick around as we break down why this generic guidance can be misleading and what you should focus on instead. So, what's the issue with basic trading advice? Let's break it down! First, oversimplification. Advice like buy the dip sounds great, until you realize not every dip is a buying opportunity. Without proper analysis, you might just be buying into a downtrend. Second, lack of context. Phrases like cut losses early are powerful, but how early? If you sell too soon, you might be exiting a perfectly good trade just before it recovers. Finally, potential for financial loss. Following basic strategies without understanding market behavior can create a false sense of confidence. Many traders end up risking more, thinking they're playing it safe, until their accounts tell a different story. These surface-level strategies often fail because they don't consider market dynamics, personal trading styles, and risk management principles. Let's explore this further. Let's break down some of the most common pieces of advice in trading, and why they can often be misleading, oversimplified, or even dangerous if taken at face value. Buy low, sell high. The half-truth that hurts traders. At first glance, this advice seems like the ultimate trading rule. After all, the goal is to profit by buying an asset at a lower price and selling it when it rises, right? Why it can be misleading. Number 1. Markets don't move in straight lines. Financial markets fluctuate with volatility and often trend in unpredictable ways. What seems like a low can just be a pause in a larger downtrend. Number 2. Catching a falling knife. When a stock or asset is dropping, buying it just because the price is lower without proper analysis can lead to holding on to a losing trade as the price continues to fall. This is known as catching a falling knife, trying to grab an asset on its way down and getting hurt in the process. Number 3. No context provided. Low relative to what? A price that's low today could still be overvalued based on market conditions or economic indicators. What to do instead? Number 1. Use technical tools like support levels, RSI, Relative Strength Index, and Fibonacci retracements to identify when a price is genuinely oversold and likely to reverse. Number 2. Apply volume analysis to confirm whether there's genuine interest from buyers at those levels. Number 3. Understand market trends before assuming a dip is a buying opportunity. Cut your losses early. The risk management rule that needs refining. Yes, risk management is critical, but the common advice to cut losses early often lacks the necessary context for effective decision-making. Why it can be misleading. Number 1. Premature selling. Selling too early can result in closing a position before a healthy retracement has had time to play out. Minor pullbacks are common in both bullish and bearish trends. Number 2. Emotional reactions. Fear of losing money can lead traders to exit a position before their strategy indicates they should. This often happens because traders lack a structured approach for when to exit. Number 3. No clear definition. What exactly does early mean? If a stock dips 2%, should you sell immediately or wait for 5%? Without a defined plan, it becomes subjective and inconsistent. What to do instead? Number 1. Define a stop-loss strategy. Set a clear percentage or technical stop-loss level before entering a trade, such as just below a support level. Number 2. Use trailing stops. A trailing stop moves with the price and allows profits to run while capping potential losses. Number 3. Understand trade setup. Identify whether you're in a trend-following trade or a mean reversion trade. Each requires different stop-loss strategies. Follow the trend, effective until it isn't. Follow the trend is another popular mantra, especially among momentum traders. It suggests you should enter trades in the direction of the current price movement. But there's more to it than meets the eye. Why it can be misleading. Number 1. Trends reverse suddenly. Trends are powerful but not permanent. A trend can break at any moment, often triggered by news events, earnings reports, or shifts in market sentiment. Number 2. Late entries. Many traders get caught entering a trend late when much of the momentum has already played out, leading to minimal upside and greater downside risk. Number 3. Pullback confusion. Small retracements in a trend often scare traders into exiting, mistaking normal corrections for reversals. What to do instead? Use confirmation tools. Tools like the Moving Average Convergence Divergence, MACD, or the Average Directional Index, ADX, can help confirm trend strength. Identify trend phases. Markets go through accumulation, uptrend, distribution, and downtrend phases. Understanding which phase you're in helps avoid chasing trends. Have an exit plan, determine profit targets, and stop loss points before entering a trend trade. Always diversify your portfolio. Useful, but not always optimal diversification is often promoted as the ultimate risk management tool. Spreading your investments across various assets to reduce exposure to any single risk factor. Why it can be misleading. Number 1. Over-diversification. Holding too many positions can dilute profits and make it harder to monitor your trades effectively. Number 2. False security. Diversification doesn't always protect against systemic risks, like a market-wide crash. Number 3. Quality matters more. A few well-researched positions often outperform a large basket of poorly selected assets. What to do instead? Diversify strategically, not blindly. Ensure each asset serves a unique purpose in your portfolio. Avoid excessive overlap. Owning 5 different tech stocks isn't truly diversified if they all move with the same market conditions. Focus on non-correlated assets, for example, stocks, bonds, commodities, for better risk balance. Why do traders fall for this advice? At the core of why people cling to basic trading advice lies the psychology of certainty and herd mentality. The brain craves simplicity. Simple advice like buy low, sell high feels intuitive and easy to remember, even if it's incomplete. The human mind prefers easy-to-process ideas, especially when the stakes feel overwhelming. Herd mentality. When everyone around you is following the same advice, it feels safe, even if it's not effective. Social proof creates a false sense of security. Confirmation. Bias. Traders often seek information that reinforces their existing beliefs. If someone believes cutting losses early is the key, they'll ignore situations where holding on a bit longer would have worked better. Fear of complexity. Markets can feel overwhelming. Basic advice promises simplicity, while real success requires deeper understanding and effort. Now let me share a personal story that really opened my eyes. A trader I knew, let's call him Mark, was following the classic buy the dip strategy. Every pullback he bought more, believing the market would rebound. But he ignored volume trends and support breaks. The dip kept dipping, and he wiped out a significant portion of his portfolio. This was a turning point for him. Instead of sticking to generic advice, he learned to incorporate technical analysis tools, set proper risk-reward ratios, and develop a trading plan tailored to his strategy. The lesson? Surface-level advice can't replace deeper market knowledge. To sum it all up, while basic trading advice might sound useful, it's often oversimplified and lacks the depth needed for real success. The markets are complex, and succeeding requires context, education, and discipline, not just catchy one-liners. Remember, trading is a skill. The more you educate yourself, the better your decisions will become. Have you ever followed basic trading advice that didn't work out? Share your experiences in the comments below. I'd love to hear your stories. Don't forget to subscribe for more insights to help you master the markets. See you in the next one.